Hi, this is Rizvi here. I just wanted to get a study group together on our group so that, we can kind of learn from each other and just quickly summarize all these different sections. And it's way easier if we work together as a team rather than if we do this individually. I have created a little bit of a Excel document walking through the different things that I would want to cover if I was going through M1, for example. So this is R5M1. So the difference between a C corporation and an S corporation. So when it comes down to it, C corporations and S corporations are very, very similar. When there's four accounts, so after you've accounted for your income and your expenses, you get down to the current earnings / profit, and then you also have your retained earnings or accumulated earnings, and then you have your return of capital, and anything over your return of capital would be your excess. So I'm just going to go into each one of these options. So the current earnings or profit for the year would go over here, and if you do get dividends for that, that would be a taxable dividend. The other option you have is sometimes companies have retained earnings, and so they're holding cash there for a future date. And sometimes, you only made 70,000 during the year, so that's your current profit, and you have retained earnings of 50,000. That's going to be 120,000 of dividends. So if dividends are issued that year, it would hit both of these different buckets. Now, if it was 150,000 worth of distributions made to the shareholders, in this case, you would get return of capital. So return of capital is essentially when you first put money into a company, put assets into a company, that is going to be your basis. So return of capital is essentially up to your basis. So whatever you've put in, you get back out, and that's why it's tax-free, because this is technically your own money that you're taking out at the end of the day. Anything over that is excess. So any excess amount is going to be capital gains, and you are going to be taxed on that. So the difference when it comes to an S corporation is that they don't have a current earnings / profit. Everything is accumulated adjustment account. This basically means that you have some money there that's accumulating. This is not taxed when you take it out. The reason being, in an S corporation, as soon as you make money, as soon as you've earned anything, it goes right to your K1 for your portion of the earnings, for your portion of the profits. So essentially, you're taking your own money out of the bank account, and this is after tax. Whereas in C corporations, the corporation is taxed, and then you receive money and you're taxed. Here in an S corporation, it would go right into your bank account. So that's why this is not taxed. If the C corporation was previously an S corporation, you have a retained earnings here as well. And as you can see, this I've made red, this I've made yellow, and so this is why this is orange, is because when a C corporation goes to S corporation, that's the only time there's retained earnings in an S corporation, and that is taxable. And then you have your return of capital for each one of these, and the excess, which is the same concept. So the only difference is this account over here is different, and this will only be here if you were previously a C corporation. So the key dates that we should take a look at. So C corporations, they can have a year end at any point in time, whereas S corporations, their year end will be December 31st. Switching between the two, if you want to go to a C corporation to an S corporation, you have to meet some of those, you have to elect to be a S corporation and meet the requirements of an S corporation. Once you go back to a C corporation from an S corporation, you do have to wait 5 years to switch back, or you can send a message to the IRS to request to be made into a C corporation again. Whereas to go from a C corporation to an S corporation, elections by all of the shareholders need to be an election needs to be made, and then once the election's approved, if it's before March 31st, it would go to January, so it would be backdated to January. If it's after March 31st, it would turn into S Corporation for the following year. One of the limitations is no corporations or partnerships can be a shareholder of an S Corporation. And when there's a C Corporation, you have preferred shares or common shares. When you have an S Corporation, you can only have one of the two, one class of shares, but you can have different types of shares. So you can have common shares with voting rights and common shares with non-voting rights. That's still one class of shares. Now, when it comes to a tax basis in a corporation, you have basically, in this example, there was a basis of 30,000. There was also a loan of 10,000, and this was for year one. Then in year two, what happened was there was a loss of 75,000. So we take off the basis. The basis is negative 30,000. We take off the loan, and then the rest of it goes into a suspended account. And now you see the total here is negative 75,000. The following year, in year three, there was a gain of 50,000. And so your basis was 40,000 and your loan amount was 10,000. So first you establish the loan amount. So you would write the loan back up to $10,000. Then your second place where you'd go to is your basis. And so you would put the rest into your basis. So the total should be $50,000. Now that $40,000 is going to basically be income to you. So now at that point you need to use that $35,000 that was suspended loss, and your ending would only be a gain of $5,000. So now your total here is 15 as your basis. And so that's how you calculate tax basis for S Corporation. Termination of S Corporation. So holders of a majority greater than 50% must consent to terminate. Whereas if you're creating an S Corporation, you have to have 100%. Here you have to have greater than 50%. Corporation fails to meet all eligibility requirements. So for example, you have a corporation that's a shareholder, or a foreign shareholder, or a partnership as a shareholder. And if you have over 100 owners, so a family can elect to be one owner together. More than 25% of the corporation gross receipts come from passive income. This is one of those triggers, but it has to be over the last 3 years, and the company has to have previously been a C Corporation. If this is not the case, then they're fine to remain an S Corporation. This should be definitely not E, should be D, but that's fine. If terminated, either wait 5 years to re-elect or ask IRS for permission. I've covered this above, and termination date is at the beginning of the tax year. Liquidation. So this is something, I believe this question came up in the group, so I wanted to go over liquidation really quick as well. So maybe the company made a liquidating contribution, whatever you call it, to a shareholder. In this case, let's just say the basis was 60,000, the fair market value was 100, there would be a gain of 40,000 over here. Let's just say the person's basis existing at the company was 30,000. The company made $10,000 that year, and then there was the gain of 40,000. The total basis, or the total distribution, would be the cumulative of 1, 2, and 3. So their basis, or their distribution at this point would be $80,000. So that's the way that basis works. This is their total basis now. This is capital gain on building. So this is how it works. I just wanted to quickly go over that. I could see that there was a need for this, and this only took 10 minutes. So if we can somehow get a group together where we can all cover a certain aspect of the Reg Exam and come together and just share like our strategies and pretty much share the main concepts, this is essentially what I want to do and what I want to put together. So let's see.